Hi, everyone. Thanks for joining us today for our Rehmann Cannabis Industry Series webinar. Today, we've got a great group of presenters here to talk about some federal and state considerations as we continue to move through the year here, coming towards the end of 2022, but into the midterm elections that are on the horizon. So I will be your host and kickoff here, Eric Shoemaker. I lead our tax practice with our cannabis industry group. The folks you see on your screen today will have a lot of good content, a lot of good information, and they're some of the key players in our industry practice group, along with myself. So, we've got a pretty packed agenda. I want to make sure that we get a chance to get into it and get everybody a chance to cover their information, and then maybe and hopefully leave some time at the end. I have had a chance to see the attendee list, and I recognize a number of names as clients or friends of the firm and businesses. So welcome and thank you for joining us. And then for the few names that I do not recognize, welcome and thanks for joining Rehmann today as we continue to put some information in front of you that you hopefully can get some use out of. So let's move on to the agenda real quick. We're going to get into just a couple election and proposal legislations that sit out there. For sure, one that I'm sure you're all very well aware of, and then a couple that are percolating there through Congress and see what happens. We'll get into a couple updates on 280E as it relates to some federal items that have changed, but then also on the Michigan state and local side. I think most of our attendees here are located in the state of Michigan. And then we'll move into our state and local team getting into some sales tax considerations. So with that, let's get into our first agenda item, and I will hand it over to Katie and Jonathan from the team.
Thank you, Eric. My name is Katie Sabo. I am a senior in our Ann Arbor office. I've been working in this space for a couple of years now. We've got a good team here, so hopefully we've got some good information you guys can use. We can go on to the next slide. So we just wanted to go through some of the states to pay attention to. With the election coming up, we're certain there are more states looking to legalize cannabis in some form or another. Obviously, the more states that start to legalize it, the more pressure that puts on our federal government to make some type of a move towards legalization as well. So I'm just going to run through this list that has some 2022 ballot measures. Each of these states have some type of a proposal or initiative on the ballot in this November election. So first is Arkansas. Arkansas has a proposed constitutional amendment on their ballot allowing adults 21 and older to purchase and possess up to an ounce, but home cultivation will not be allowed and there is no path to expungement. In Maryland, their proposal, if approved, will allow adults 21 and over to possess an ounce and a half of flour or 12 grams of concentrates. With amounts greater than this, those would still be subject to existing criminal penalties in the state. Missouri has a citizens initiative that seeks to allow people 21 and up to possess, purchase, consume, and cultivate marijuana while allowing those with non-violent marijuana-related offenses to automatically have their criminal records expunged. So that's an interesting piece. Nebraska, this is kind of a weird one. So it's divided up into two separate measures. The first piece being the Medical Cannabis Patient Protection Act, which protects patients with serious health conditions and their caregivers from arrest. And two, the Medical Cannabis Commission Act, which regulates private businesses to provide medical cannabis to qualified patients. So each of these received just over the 87,000 votes that are or signatures that are required to make it onto the ballot. So the last I checked, I think they're still in the process of being verified. So TBD on Nebraska. The next is North Dakota. Their ballot initiative seeks to legalize the adult use and sale of cannabis. If approved, the measure will allow adults 21 and older to possess up to 1 ounce and cultivate up to 3 plants in their homes. But it also creates a process for licensing retail cannabis stores, product manufacturers, testing labs, and other types of businesses. So this looks more similar to what we see in Michigan, what we've had in Michigan. The next, South Dakota. This is actually the second election in a row for South Dakota to include a cannabis-related ballot measure. The initiated Measure 27 permits adults to possess up to 1 ounce and home cultivate up to 3 plants. It doesn't seek to establish any type of regulatory framework that will govern the production and retail sale of any products. Lastly, we've got Oklahoma. So SQ 820, as it's called, allows adults 21 and older to purchase and possess up to 1 ounce and grow up to 6 mature plants and 6 seedlings for use. It does not, it does provide pathways for the resentencing and expunging of criminal records, but it does not produce a pathway for the licensing process like Michigan. So on to the next slide, I'm going to talk a little bit about, the current proposed legislation on the federal level. So at this point, with an overwhelming majority of states having some type of legal or, decriminalized process with cannabis products, it seems quite likely that federal legalization is going to take place in some form or another. I think I saw a statistic from the Pew Research Center a while back, 2021, that fewer than 10% of US adults say that marijuana should remain illegal. So the question is, when and how do we get there? How is that going to happen? And a huge debate going on right now is over just that. How do we make this change happen? Is it going to be on a large, sweeping, comprehensive level, or is it going to be incremental? So this is something to kind of keep in mind as we go through these different types of proposed legislation today. Because that's a huge debate on these different bills. So
and one thing really quickly, just to jump in here on the Safe Banking Act, make sure our audience is aware of. So safe banking will be a huge economic, relief for this industry, right? Opening up the federal banking system to this industry. Unfortunately, it doesn't do anything to address the punitive 280E nature of this industry. So just that's a common misnomer that's out there. Folks think, oh, safe banking's going to be great. Everything's delisted. We're good to go. That's not the case. So although this is a great industry win when it passes, which I'm confident it will, it's not going to alleviate the tax issues that we deal with in this industry.
Right. Exactly. It's exactly that. It's passed the House 7 times and it just keeps dying in the Senate. And the problem that a lot of people are having is that some of the more progressive Democrats don't see it as comprehensive enough, right? They've wanted it to be, more broadly sweeping to get rid of the punitive impacts of 280E. And, then there's other individuals who just still can't get behind any type of relief for the cannabis industry. So I think with that, I can pass it on to John to talk about the States Reform Act.
Hi, everyone. Thank you, Katie. I'm John. I'm a senior here in our advisory and tax department out of our Detroit office. The first legislative item I would like to talk about is the Safe States Reform Act. The big thing about this act, we'll be removing cannabis off the Controlled Substance Act, and this would help federally decriminalize cannabis and defer all rules and guidance to the state levels. And another big thing with the State Reforms Act is we will see an excise tax of 3% imposed on all cannabis products with a 10-year moratorium on excise tax increases to help build a footing in the market for competition. Another big thing with the States Reform Act is we're going to see a national age limit of 21 years or older to use and consume cannabis. However, there still will be the medical age requirement with states that still have medical marijuana, and you will just follow those states' rules. One other large thing we'll know with the States Reform Act is cannabis will be subject with advertising restrictions, similar to how tobacco and alcohol have seen to children and minors, to defer like any, favorable comic advertising items, billboards that would entice them to try the product out. And the next slide we could go to is the Cannabis Administration and Opportunity Act. This act is very similar to the States Reform Act. We'll see also that this act is going to help remove cannabis out of the Controlled Substance Act and decriminalize it. This will also move the control of cannabis from the DEA to the FDA, and then also the Alcohol, Tobacco, Tax, and Trade Bureau, which will kind of treat it similar to alcohol and tobacco, have regulations, and FDA will help impose proper nutrition labels and ingredients and all of that. Another thing is we will see an excise tax imposed based on the company sizes. So the first few years for small to mid-sized businesses will have an excise tax of 5%. And then starting in year 3, we'll see another increase of 2.5%, going all the way up to 12.5% for those size companies. The large size cannabis businesses will start at 10% for the first 2 years and then increase 5% each year after that, starting in year 3. The main thing with the Cannabis Administration and Opportunity Act is we'll see programs developed for people in this industry who are social equity and help them get the technical services that they need to help start a business or even get loans or resources to technical people to help start their business off. Now I'm going to go ahead and pass it on to Katie to talk about the Medical Marijuana and CBD Research Expansion Act.
Perfect. So this act is intended to make it easier for research organizations to safely and legally analyze the impacts of cannabis consumption. So, it passed the House with 325 votes, and it really outlines that the DEA needs to require a specific registration procedure for those seeking to enter the research space. It's currently expected to pass in the Senate, as I think it's tougher, to make an argument against simply researching the effects. So this bill really makes sense as a first step toward the federal government becoming more cannabis friendly. So it's kind of exciting to see what will come of this research. Obviously, it isn't directly related to tax, but this bill goes hand in hand with the industry. So we kind of felt it was important to give a little update on it. So I think going on to the next slide.
Yeah, before we jump forward, I just wanted to make a comment. So I had the pleasure of being on a panel discussion last week in Detroit, and Bob Hoban, who's I think world-renowned cannabis attorney, was part of that panel. And there was a comment in this kind of discussion around the social and political view of cannabis and what's the likelihood that anything moves forward, right? Now it may be waning, but if you went back to the beginning of the summer, there was a consensus that there was probably going to be a Republican change in control, maybe more Republican seats taken for sure in the Senate, or for sure in the House, and maybe even in the Senate. And the comment was something along the lines of, is that good or bad for the industry? And Bob was quick to point out that even with a Republican controlled Congress, the likelihood that some of these bills are just going to be shelved and not talked about for 4 years is really low. That they're going to continue to talk about this. And if you really look back at it, it's actually Republican-controlled Congresses that have voted and put in place some of the most sweeping cannabis and marijuana regulations to date, primarily being the hemp farm bill, right, that brought hemp into the forefront. So his comment was, and I think there's this general sense that, man, if Republicans control the Congress out of the midterms, we got to push all these bills 4 years out before anything might ever happen again. And his comment was, no, I don't think that's the case. I think we get through the midterms, and this is going to be a continued subject that's going to bring this to the forefront, and we'll probably see some movement on these, hopefully, in the next 4 years. So that was a pretty positive that I took away from that conversation. I just wanted to share that with the group.
Awesome. Yeah, that's exciting. So I think now we can kind of move on to more tax compliance updates. This current update might not really alleviate the pains caused by 280E or even assist in calculating the taxable income. But the IRS has listed out many of their initiatives to help taxpayers in this space navigate the complexities of calculating and reporting tax in the cannabis industry. So we just kind of want to talk about a few of them, of the ways that the IRS is trying to make it easier for taxpayers. So one of the initiatives that they're hoping to take, though it's not entirely clear on how they'll get there, is by collaborating with external stakeholders to increase the awareness of tax responsibilities in an attempt to improve compliance. So, I can't really tell you how many surprised investors there are in this industry. They get these financial statements and they see the entity has a loss, but come tax filing time, they get a nice K1 with a taxable income number and are kind of shocked. We do our best as advisors to assist our clients in preparing their shareholders for what may come, but many investors still don't fully grasp the concept of 280E and just how burdensome it can be. So it'll be interesting to see what the IRS is working towards here. Another one of their goals is to improve the consistency in their approach to these returns. So I gave a presentation on 280E a few months ago to the MICPA, and we had a guy in the crowd stand up at the end just because he felt the need to share that he had went through an IRS audit with a cultivator, and they had been taking bonus depreciation, a method that we, during our presentation, said we didn't feel cannabis taxpayers were eligible to take or use. They got through the audit. There were no proposed adjustments, but this is a reminder that just because an auditor doesn't catch something or comes back with no adjustments, that doesn't mean it's not incorrect. So this goes back for the need for consistency in this arena. And as actually this summer, a case on just this issue went to court, which I think John is going to talk about on this next slide.
Yeah, and so the one thing on the IRS side, just so everybody's aware, this is a new industry for everybody, right, including them, although they've maybe had a little more forefront than some of our friends here in Michigan with, being involved in the early court cases out in California. But it's a relatively small group that has had that knowledge in the IRS. Their goal, right, is to spread that knowledge and develop these working tools that they have for every other industry group. And the word of caution there is, to the comment of the gentleman who stood up at the end of Katie's presentation earlier in the year and said, hey, we made it through, and so they must allow it, I think was the kind of the comment. So I can do it with all my clients. Is no, just because you had one auditor who maybe either didn't know that or wasn't fully aware of what the IRS's position is on that, it doesn't mean that everyone's going to be that way. And they're trying to develop the tools to create that consistency in their audit approach. And there have been some documents released under Freedom of Information Act from the IRS by some tax attorneys who made that, and this is going back a couple of years now. And it's very clear that the IRS is taking a very, very conservative and aggressive approach to 280E and what's deductible, especially when it comes to retail operations. So I just say that as a word of caution that the IRS is becoming much more educated in the space. Here in Michigan, it's such a new industry. We haven't seen the wave of audits that we're seeing in other states. They're coming. We're going to have our clients that we're going to be sitting across the table with the IRS on these issues. And just be aware that, the real path forward of alleviating these issues is really legislative change. It's not the IRS's attitudes drastically going to change towards this industry.
Thanks, Eric. So yeah, like Katie was mentioning, this case, Lord versus Commissioner. In this case, we saw that the Lord was taking bonus depreciation, and it kind of stems back to Lord never needing audited financial statements for non-tax purposes. And with him not needing the non-audited statements, he ended up deciding to go with a tax basis method of accounting for his business. And with taking the tax method, he also decided to use the accelerated cost recovery method, which is also known as bonus. The commissioner did agree that they were following the proper rules they were following Section 471 accounting for inventory when it came to their dispensary and cultivation. But they did state that there is a couple tests with 471 that needs to be followed. One is conforming as nearly as may be to the best accounting practices in the trade or business. And the second test is to clearly reflect income. If we look at the first test, the best accounting practices for a trade or business would conform to GAAP. And under GAAP, you would be following the straight line depreciation method. And in our case, Lord wasn't doing that. They were following tax basis and using bonus. So it's not really conforming to the best accounting principles accepted for this trade or business. The second test is clearly to reflect income. Well, if we look to clearly reflect income, it should be consistent year over year. And if you're taking the advantage of bonus, you're not really clearly reflecting income year over year consistently. You're taking bonus, depreciating a full asset in 1 year, and then the next year you don't have any. While if you were using the straight line, we are staying consistent year over year, which helps reflect the proper income.
And I think this clarification, so everybody who's listening understands, the tax court didn't say that, a trade or business can't take bonus because it doesn't clearly reflect income. We're really talking about the 471 rules, which are the tax inventory accounting rules. And again, 280E, we can only deduct what we can consider inventoriable cost. And under that regulation, the tax court made the interpretation and decision that bonus depreciation does not end up in your inventory cost. You can take it, it's a tax deduction, but it doesn't end up in cost of goods sold. And as such, if you did take it, it's just a non-deductible expense on your tax return.
Thanks, Eric. And yeah, so the next big thing we're seeing here in the cannabis industry are the Form 8300 audits. This form was designed for anti-money laundering, where any business or person who receives more than $10,000 in cash in a single transaction, or two or more related transactions that do total with up to $10,000, are required to fill out Form 8300. The big thing about these forms is these forms are required to be filled out within 15 days of receiving the cash. And for example, if you're doing installment payments, that form needs to be filed 15 days after the cash totals exceeds $10,000. And we all know with cannabis being a heavy cash industry, we recommend that all staff who are potentially receiving cash be trained on filling out these forms. And this should be a regular standard procedure in your day-to-day business.
Yeah, so this is a more complicated and laborious compliance item that is often, I don't want to say overlooked, but just maybe the adherence to, are we doing it 100% of the time? Are we really doing it at that 15-day window? Or are we just doing it monthly, quarterly? And it's another one of those things, right, that we don't have the greatest bandwidth in our back offices in these businesses. So it's an easily overlooked issue, but we are seeing these audits. We are seeing them in our client base. And, the field auditors who are doing this are bound by statute to apply some of these penalties that you see here on the screen. The only way to negotiate beyond that is to go through the appeals process, which takes more time, money, and effort. And we've got some clients that we're helping through that process to help negate and to get some of the penalties waived. But it is, again, just something to be aware of. And the auditors they have in the space, this is what they do. They're not income tax auditors who are just dabbling in this Form 8300. I've one particular audit that comes to mind. The auditor was out of California. He's been doing this in cannabis in California. Prior to that, he was working in the automobile dealership space, another place where they see a lot of large cash transactions for down payments. So these guys know what they're looking for. They know what they're doing. Just be aware it's something that it's a laborious process, but very important to make sure that it's part of your regular compliance checklist.
Yep. Now off to our state and local team.
You're still muted if you can hit the button, please.
There we go. I'm Chuck Wright, Senior Manager in our Traverse City office. I've got Lisa Pohl, who's Director of our team for state and local here at Rehmann. And together we're going to talk about some of the things we're seeing here as we deal with these same issues here in Michigan. And I think Eric's point is well taken that Michigan Treasury is really on a learning curve here. This is a very new industry, particularly on the recreational side, just a few years of experience, and they are really experiencing some growing pains as they try to work through these issues. Let's start off with 280E. As we all know, those expenses are disallowed for federal purposes, and because the vast majority of businesses here in Michigan, at least our client base, are flow-through entities, partnerships, LLCs, S-corps, and Q-subs, for example. These items flow through from the federal side. So we've got disallowed federal expenses that are driving federal income higher for the entity. And we've got K-1s going to the owners reflecting that higher business income. And then Michigan income tax for an individual starts with federal AGI. And the Michigan Income Tax Act does not have any reference to 280E at all. So there we are. Now we're sitting, the base of our return is an inflated business income number because we've got a disallowed 280E expense. The issue we have in Michigan is that this is, and I'm not getting, there we go. The Michigan Medical Marijuana Act legalized marijuana for medical use in 2018. And at that point, we had no reference or any basis to have a different change in our treatment of 280E expenses. But MRTMA, the Michigan Regulation and Tax of Marijuana Act, legalized recreational marijuana in 2018. And part of that law, that was a taxpayer initiated ballot law, contained a provision allowing all marijuana establishments, in quotes, to deduct 280E expenses. I think that was very intentional on behalf of the drafters of this bill. And the definition of a marijuana establishment is contained right in MRTMA. It's a very broad definition, basically saying any type of marijuana related business that is licensed by the Marijuana Regulatory Agency. So that covers pretty much everything. And on that basis, the Michigan guidance, even issued by Treasury, came out and said, yeah, it looks like we're decoupling from the federal treatment. There's language directly in the RABs as recently as 2017 that talked about, yeah, we recognize that we are decoupling. There was some very vague language saying, yes, but this RAB deals only with recreational use. So when we go to the Michigan treatment, typically our owners are looking at the MRTMA language and we're taking a subtraction on our 1040. Miscellaneous subtraction, we're starting with a high number in our AGI starting point. We get to Schedule 1 and we take a 280E expenses deduction, miscellaneous subtraction, because it's legal here. Everybody knows that. Treasury's guidance is out there. Treasury has been sending notices on these subtractions and requesting very detailed information. I think having done this for many years in Michigan, I think the basis for these denials is because as a starting point, the form triggers that inquiry because that subtraction line was never supposed to be used. And it would say right in the instructions, you can't use this miscellaneous subtraction line. It is going to cause a notice. We don't know what it is. It's not allowed. There isn't anything that's subtractable. What they're doing is requesting very detailed information on what that subtraction is. They ask for breakdowns of expenses. What is the basis for it? If it hasn't been disclosed on the return as a 280E expense, they will ask for very detailed schedules breaking that out. Their position is that the 280E subtraction was never intended to apply to medical marijuana. And this took us a while. We've been getting these notices, and it took some very pointed inquiries that we made with Treasury at the policy level, kind of very high up, the think tank, our ivory tower of Treasury, as to why we're getting these things. We don't understand this. This is clearly deductible. And their position has been, as recently as a few months ago, we're starting to put these pieces together, that they are denying the medical element of 280E expenses. So if your business has multiple licenses, and many do, they will request a basis and a calculation and support for what is the recreational adult use piece and what is the medical piece. And the documents that we have been providing to get these cases resolved. Some of them have gone all the way to informal conference, and we're resolving them at that level, but we have to provide quite a bit of documentation if the taxpayer wants to go that way. Typically, the medical piece is smaller than the adult rec use, especially as we move from 2020 into 2021. The adult use is much larger, so the medical piece is not as substantial relative to the entire deduction. What we've done is document the entire subtraction from the federal entity return, the 1065, the 1120S schedule showing the disallowed 280 expenses, then showing the owner's piece of that, their K1 showing this is our piece of the business, it's 50% or whatever it is, our ownership interest. Here's how we calculated the subtraction on our return. Taking that number, here's how we would break it out. Here's how we're going to bifurcate that 280E expense between medical and recreational. Some of the bases that they have accepted is a ratio of sales. So we may look at our excise tax returns and say, this is the amount that we remitted total. Here's the amount that was subject to excise tax because it was recreational use. Here's the total, here's the ratio. They have accepted that. So that's a heads up to everybody on what may be coming if your owners are going to be taking this subtraction. Another one they have suggested is a square footage of gross space, probably a little harder to document, but those are suggestions that Treasury has made on how to resolve this.
And I just was going to, add similar to what
Please.
Eric had said earlier about someone going through an audit, and just because someone's made it through an informal conference and something's been accepted by the state has failed to provide any guidance on what is acceptable. So they've been quick to issue denials and not allow the deduction. And they've promised some forthcoming guidance, but as of yet have not provided any guidance. We do know, and I think maybe on the next slide, we talk about some documentation and some approaches to filing some returns. We know that documentation is needed. We know that they expect a ratio, but we can't guarantee, nor can the state guarantee, that if you do all of these things, that you still won't get a notice, or that if you do one of these prescribed methods, that they won't challenge it. So it's very important that if you're getting anything from any of the governmental agencies, that you're reviewing what it is and that you're promptly and timely responding to it. All of them are tied to if you want to, disagree with the notice or appeal the notice or continue to, fight for that deduction, that you respond in a timely manner. So even though these have been accepted, the state has not come out and affirmatively said that, yes, we agree that this is a valid way to support an allocation of the 280 deduction.
Okay, thank you. I completely agree on the timely response. When you don't respond, you get assessments and things, and the appeal clock really starts running. But I may just backtrack a bit on my conversations with Treasury on this, because I've gone back and forth with some of the senior attorneys on this, trying to understand where their position is coming from on this, because the language of MRTMA is very, as I said, broad, and it would seem to be all encompassing. I don't see anything that would limit this only to rec use. The response I got was, yeah, but it just doesn't make sense to limit it or to allow this to cover medical use. It doesn't make any sense, because if you're a marijuana establishment, it means that you have to pay excise tax. Well, that's not exactly true. The excise tax is imposed on retailers, which has a separate definition right in MRTMA. They talked about a lot of statutory construction principles and things, but the plain language of this law would seem to allow it. I think what we can take away is that they will challenge it. I think if we take a subtraction of any kind on that miscellaneous line, we're probably going to get a notice. It doesn't mean it's necessarily a denial or you're not going to get anything out of it. It means they don't get it and they want more information and we need to respond. Lisa, anything else, or we can move on?
No, I think that does cover it. I mean, I agree. I think everyone being the accountants and the attorneys are confused at how Treasury has come to the conclusion that it doesn't apply to the medical side of this. And we're waiting for their write-up on how they came to that conclusion. But in the meantime, that is where we're at. And we're just trying to help the business through just getting those returns filed and helping them focus on their business and get the tax portion behind them.
And I did ask for some, maybe they could walk me through their argument, and they refused to do that. So who knows? They have said that there is a new revenue administrative bulletin coming out this fall. It should be as recent as a few weeks from now. That will be out for public comment, and we are, part of those organizations, the MICPA and the Michigan Bar Association, that will be looking at those and providing comment. But I think at that point, we'll know at least what their reasoning is, and we can have a better understanding of the strength of their arguments. But there should be more coming out very soon. Okay, what do we recommend? This is kind of what we're boiling down to. What do we say to our clients that are asking, how do we file our returns going forward? I think as a basic tenet, we should have documentation to support the deduction. So what I would do is have a calculation showing, or a statement showing, here's my federal number from the entity, here's my ownership percentage, here's the amount that I'm taking. Now, a low risk position would be if you don't have any medical use. Obviously, that should be stated in your statement that this subtraction does not relate in any way to medical. This is 100% adult use. It should be completely allowed under the MRTMA statute. A medium risk statute would be an allocation like I described, that has so far been through a couple of conferences and seems to be what they're asking for in order to resolve this at least at the hearing level, is that we compute based on the easiest method I've found is based on our sales. And we can document that. We don't have to necessarily include all of that with the return. We should have at least a detailed calculation showing how the number was arrived at. We could include some exhibits in PDF from the federal return. We could include the K-1 as much as we want to. I think in either case, it is going to result in a notice asking for more information. So we could save some of that detail for that inquiry. We should be ready for that notice. It shouldn't be a surprise. A high risk position would be, and one that will be denied and will need to go to appeal, would be 100% deduction regardless of the ratio of medical or recreational. It may be the correct position. It may be the only way to get the 100% deduction is to take it and make an appeal issue out of it. But you can certainly be assured that it's going to be denied and it will need to be appealed. Okay, let's move away from 280E and go to one of the other major issues we're seeing from a state standpoint in this industry particularly, but even more broadly in our practice. sales and use tax issues are a huge issue and probably generate 70% of the questions that we get. The issue is, for this industry and any industry, compliance with sales and use tax it can be a hassle. It can be an administrative burden. You need to register entities. You need to go into the MTO system and fill out forms on a monthly basis in many cases. If it's done incorrectly, the downside is very painful. It is, you're underpaid on something, you don't have the documentation, you don't have the process in place to support your deduction. That item could be picked on audit as part of the sample, and it gets extrapolated back as long as you've been in business. It's much easier to address this proactively and get the process in place. It can be difficult to get that process going, but I think it's well worth it on an audit. Sales tax, I said, basically, the reason the state is so focused on it is because it's so lucrative to the state. It is a much greater portion of state revenue than any other tax. It's where they make their money, and it's where they have put their resources. It is 6% of the gross transaction. It's not 6% of income. And as we'll see, there can be many transactions within the same business that are all taxable, and it's on every transaction. The focus in sales tax is very much on the entity itself. And I think one thing to take away is when we talk about the entity, we're not talking about the federal taxable entity, the top tier entity that all the DREs and the disregarded entities flow up to. They can be disregarded for federal tax purposes, but for sales tax purposes, those are taxable taxpayers that have transactions. And even within the same umbrella organization, every one of those transfers is a taxable transaction. In order to issue any exemption certificates, you have to be registered with the state. So there's a lot of money here, and Treasury knows that this is an industry that has a lot of transactions with a lot of dollars, and they have a lot of entities often involved. So they know they're gearing up their audits, they're training people, and they may have been behind the curve, but they are really starting to gear up, and we're seeing audits of our clients get started. This is an example structure. This was actually similar to a one that we assisted about a year ago. What you'll notice is we've got, in this case, we've got a holding entity that is, in this case, let's say it's an S Corp. The other entities are all disregarded Q subs. For federal purposes, they wouldn't exist, they're disregarded, but they do have FEIN numbers. And in many of our clients' structures, we do have somewhat special purpose entities, and we've allocated the real estate function to a separate entity. The acquisition of the equipment is in a separate entity. There's a service providing entity that houses all the people, that has the payroll function. There's a cultivation entity that grows, that supervises that operation. There's a separate entity that does the processing for products, for gummies, for vape products, things like that. And then we have a separate entity for retail. And this is similar. Sometimes there are more entities, sometimes fewer. But I wanted to illustrate what can a typical structure would expect, and some of the sales tax implications that we can have. The first issue is that we're buying a lot of power. The real estate entity may buy that directly from DTE. Now that's a taxable transaction. Electricity is tangible personal property. In Michigan, it is 6% taxable. So when the real estate entity buys that electricity, it is paying 6% tax. Then that electricity is often billed over to the cultivation entity where the lights are, the humidity equipment. It can go as a separate invoice monthly with the rental payment. That's another 6% taxable transaction between entities. We have lights and tables that are purchased by the equipment entity, and that is 6% taxable sale of tangible property. Those are leased or sold to the cultivation entity, typically leased. Those would be taxable as well. The cultivation entity buys seeds and fertilizer, any other supplies that it requires for the cultivation. The assumption would be when Treasury comes out to audit that that is taxable. Cultivation sells down to processing, taxable transaction. And then processing sells to retail, taxable transaction, 6% every time. And then cultivation can also sell raw product down to the retail operation. All of those are 6% transactions. Finally, we've got our product sale, which is what we would expect is the retail transaction. And who should pay that? That's our customer. Johnny Doritos is going to be picking up the tab for that. The point of all of this is that we would want that last transaction to be the only taxable transaction. That's what we would be expecting. But we've got all of this other stuff going on. And this is what Treasury is going to look at and make us prove each one of these is exempt or has some reason not to be taxable. So I'm going to go to the last, potentially, how would we address this? So here are all the transactions that we talked about. The real estate entity could issue DTE an exemption, a sale for resale exemption, because they are going to buy that electricity, those electrons, that tangible property, and they're going to resell it. They're going to issue DTE 100% retail resale exemption, so no tax. So that goes away. When that product, that electricity is sold on to cultivation, cultivation would issue real estate entity an exemption certificate. And we have to be formal with this. We have to get this in place. This is the attention that we have to pay. These are the hoops we have to jump into in order to avoid hundreds of thousands of dollars of tax. The dollars are huge. But if we issue an agricultural exemption certificate here, we are a grower, that cultivation entity, that should fly. That is pretty clearly in both the audit manual and in the statutes that energy is an exempt item if it is properly for cultivation. Another exemption for resale on the equipment. This is going to be resold or released. So that purchase, that initial purchase of equipment, which can be, obviously very big dollars, should be exempt for resale or for release if it's going to go up to the cultivation entity. And again, the cultivation entity would issue its affiliate an exemption certificate based on agricultural. And these are all on the same form. We just have to make sure we meet all of the criteria. So here we go, agricultural again on the seeds and the fertilizer and other supplies. So here's an interesting one. Cultivation is selling down to processing. Processing is making a new product out of it. That is industrial processing. So that should be the basis of that exemption from the processing entity issuing to its affiliate, the cultivation entity, saying, no, we're going to use this in making a new product. It is exempt from sales tax. So again, we save 6% on that transaction. Exempt for resale. So now we've got a product, we've made the gummies, whatever the product is that we're going to sell at retail, and we're selling it on down to an entity in its current form. It's not going to be transformed, but it's going to be sold at retail. And the same here, exempt for resale. And there's the last transaction. That should be the only transaction that is paying tax. And we've put that on to our customer where it belongs. We just need to collect and remit, and we should be good. This is going to generate both a sales tax and an excise tax. But the point is that all of these transactions, we can address all of these. We need to hit all of the requirements for those exemptions. But if this is addressed properly, most, if not all of this should be exempt.
And I'd like to jump in and just say that it should be addressed contemporaneously. So
Right.
even though these are all, in our example, related entities, and all this is happening, and I know everyone's really busy and stuff is moving quickly, the best way to address this and the best way to be prepared for an audit is to take the time, make sure you meet the exemption requirements, and you're getting the paperwork and it's in the file at the time. On audit, oftentimes there is a time frame where you have a chance to go back and, I'll say, straighten up, clear out maybe some of the paperwork. It's not always as easy as it sounds, even between related entities. And especially if there's been some transactions and there's been a change, any type of change in ownership, that might not always be as easy to track down and get some signatures when there's a party that's no longer an interested party. So and there's no reason to be paying tax if it's exempt. So and in an audit, somebody will be paying greater than that 6% because that amount is extrapolated over the entire amount of the audit. So I just wanted to say that, it seems, I don't know, kind of silly or maybe kind of crazy if we're talking about all related entities, but it's so important to try to get that information contemporaneously.
And I would just add to that too. It's most of the time the auditors understand, and they will sometimes allow you to get these exemption certificates going back, and other times they won't. They really will stick to, this is the audit period, you were supposed to have this in place. I've had a couple situations like I want to say on the electricity issue with the real estate entity. We were able to get a refund of several $100,000 on electricity that from DTE. The utilities are actually pretty easy to work with on that. And some of this, I've run this by Treasury, and they have agreed that if we meet these criteria, these exemptions, there's no reason why this example should not be completely valid. So something to give some thought to, and we'd be glad to help you walk through any questions that you have. I wanted to go through just briefly some of the exemptions that we talked about and talk about what the requirements are and what they cover. The agricultural exemption is obviously, we've got a great picture. Thank you, Sam, for that. Sales of goods are exempt, and sales of equipment as well, if sold to a commercial producer of crops, livestock for sale. That's basically the exemption in a nutshell. It was intended originally for farmers, but we've determined that this industry does qualify. They use the term things of the soil. Only exempt if the goods are used in agricultural producing. So you can be an agricultural entity, you can be a grower, but if you buy a lawnmower for the outside front yard, that doesn't count. It's only for the agricultural producing of things that you are eventually going to sell at retail. So equipment, machinery, tools sold to a producer for use in production. The key here is that it has to remain as tangible property. If it's affixed to the real estate, it's considered a real property transaction, and it doesn't count. It's taxable. Components, these are your seeds and plants, your supplies, fuel and electricity. As we talked about, that is a major cost for this industry, and it's something that it may be a little counterintuitive because to think of electricity as tangible, but it's definitely very well documented in the court system here in Michigan, and sales tax does apply. So make sure you're not paying on that. The other big exemption is industrial processing. That was one that it really is intended more for manufacturers, but it's very, very broad here in Michigan, as you would imagine. The home of the big three. It's very all-encompassing, one of the broadest exemptions in the country. Property used or consumed in transforming, altering, or modifying tangible property. So again, our flower product is tangible property. Changing the form, composition, or character for ultimate sale at retail. So we're refining it, we're making gummies, we're transforming it into a new product that we don't necessarily need to be the retail seller, but somebody along the line is going to sell it at retail. So any equipment that is sold to the industrial processor for use in industrial processing would be exempt. Components, raw materials, and supplies. Couple things to keep in mind. One last slide here on retail sales tax. We've talked a lot about purchases. I wanted to touch very briefly on that last part of the transaction, the guy that bounced in and was going to pick up the tab for everything. That applies, retail should apply to the final transaction. It should be the sale to the end user of the product. And intermediate sales of product or components should not be the issue. We should be paying on the retail, the end product. It applies to the sales price of the product. In this case, it applies to the 10% excise tax as well. Really important to include the excise tax in the sales tax sales price. So $100 transaction, we've got a $10 excise tax. We are going to compute 6% of $110. The excise tax does not apply to medical use product. I assume everybody's got, their accounting systems are well able to handle that. Be careful of bundled transactions. They're not permitted under the MRTMA. However, they know that they do happen. So when somebody buys 4 items, they buy product, they buy t-shirts, they buy gummies, and they buy papers. It should be only the product that is getting the excise tax, but if all of those are bundled into a single transaction with a single sales price, the excise tax applies to everything, even the t-shirts. So be careful of that. We want to avoid bundling everything in. And then again, sales tax applies on the full amount, and sales tax applies to retail sales of both medical and adult use. A little counterintuitive. I wouldn't have expected it on medical, but there's some very kind of narrow definitions in there. So at this point, we've got just a few minutes for questions. Anything?
Yeah, so Chuck, a question here for you. Out of our individual clients, so Raymond specific, that have this 280E subtraction coming through, what percentage do you believe are getting flagged by the state of Michigan? I think the answer is 100, but yeah, I'll let you comment.
100%. Yep. Everybody that has taken it is getting a questionnaire. We're in just very different time frames on where those, how quickly we were made aware of those notices. But if we get them early, we're able to provide the documentation they need. it's up to our clients to tell us what position they want to take on this. We offer our opinion on the strength of Treasury's reasoning, and we will move ahead to resolve it, especially if the medical piece is small, or appeal it if we need to.
Thanks, Chuck. And with that, I don't see a lot of other questions coming in. If there's anything we missed, we'll get to that. There was a poll that should have just popped up on your screen. We'd appreciate it if you'd let us know what topics are of interest as we continue our webinar series here through the fall and into next year. We just want to make sure we're providing relevant data that you, the industry, are interested in hearing. So please take a moment, fill out the poll. And we again appreciate everybody taking time out of their day to join us here at Rehmann on this timely kind of update with the state and local and federal taxes. And with that, we will let everybody get back to their day. Thanks again, and thank you to my panel. Bye-bye.